this presentation, I'll look at the copper space and some of the investment opportunities it presents. However, please note that I am not an investment advisor or a stock tipper, so please do your own research before you make any investment decisions. And arguably, there's never been a better time for copper companies. The copper price has been well over $4 per pound for much of the past 2 years, and around $4.50 a pound for much of the last year. And in addition to normal demand, there's increasing demand from the electrification of the energy and transportation sectors. New demand, if you like, all of which will require huge amounts of copper. All of this has pushed inventories to near record lows. Here you see the last bundle of copper in an LME warehouse. This is the obligatory joke in the presentation. But this situation is going to be with us for a long time, providing price support well into the foreseeable future. There is a lot of talk about critical metals. Now, I'd like to argue that copper is the most critical of all, even though it does not appear on the USGS list of critical metals, as without copper, everything else is moot, except perhaps with the exception of the other industrial metals, stalwart, steel, aluminum, and nickel. Here you see copper. This is a McKinsey chart. Copper is the second most critical metal after steel. Copper producers are producing as much as they can, but this is not enough to meet the forecast demand and their production. Here the forecast demand supply gap or deficit is predicted to go to up to 8 million tonnes a year, thereabouts, in a market that's about 22 million tonnes a year. Copper producers are producing as much as they can, but their production is declining due to falling grades, deposits becoming exhausted, insufficient new projects coming on stream, permitting times getting longer, etc., and a litany of other factors. This is a slide of the first quarter production of some of the biggest copper producers in the world, and what is circled there, the aggregate production is down 3.5% compared to a year ago. These 8 companies represent about 38% of world production. Their production was down 3.5%. At the World Copper Conference in Chile in March, CRU, which is one of the main consulting groups there, they said that some $100 billion of investment is needed for the supply response to meet the forecast demand. However, he said some 50% of the projects in the pipeline are greenfield, which is a concern given that greenfield projects historically have low development rates. Indeed, several greenfield projects have been in the development pipeline for more than a decade without groundbreaking ever getting near. They said that some 25% of development projects fail to materialize due to ESG factors, and the likelihood is that this will only increase. People in Arizona, Minnesota, Alaska, and other parts of the US oppose the development of copper mines, as do people in Chile, Peru, and other places increasingly do so. A low decade of exploration spend has seen the discovery rate of copper projects fall away to practically nothing, as this slide shows, which leaves the pipeline virtually empty, although with the higher copper prices, exploration budgets are finally starting to increase, as seen in the gold line here. So let's talk about some of the projects that may help fill the future pipeline, which are in the hands of juniors. It's very easy to get lost in the data relating to grade, tonnage, cost per tonne of installed capacity and other things. And as with everything else in mining, there is a long list of caveats which will determine if a project is economic or feasible to permit and develop. But we are investing to make money, so it's not necessarily to back the next copper mine to be built. So let's start with a table with some real bling to it. This is a chart borrowed from Philo Mining, and the slide shows the best holes drilled over the past 2 years, with copper as the primary commodity on a copper equivalent grade by calculation, copper grade by interval. There we see Philo de Sal at the top. These are the drill holes that can propel a company's share price and which suggest that they may have a significant copper project. So here we see, guess when Philo Mining hit its big intercept, hole 41. This hit propelled its share price from about $4 to over $9, and it's currently well above that. I think it's currently around $20, if I'm not mistaken. However, copper deposits take a lot of drilling, so we need to look beyond a single stellar drill hit and the size and grade of the ore bodies that they can result in. When a company publishes a resource estimate, it can give a better indication of whether a deposit can be developed and whether it may eventually be acquired by a bigger company, which in the copper space is very important. This table shows various copper projects in the Americas ranked by copper equivalent resource side. The takeaway here is that big miners want copper projects with the potential to sustain decades of production. So bigger is better, right? This graph shows similar data chart data in a chart form and illustrates how few projects of scale there actually are in the hands of the juniors. So when a junior does get a project of scale, that's a pretty rare thing, and it can lead to a substantial valuation increase. This table shows the same projects, the same companies from the previous table, but ranked by grade. Grade is often the key caveat about whether a copper project is developable or desirable. Generally speaking, the higher the grade, the better. The average production grade worldwide is currently around 0.5 to 0.6% copper, which is represented by this line. And it is falling as technological advancements like Rio Tinto's Newton process for processing low-grade primary sulfides and sustained higher copper prices will ultimately whittle that number down. So that line will fall slightly as time proceeds. However, generally speaking, as I say, higher the grade, the better. You will notice that some of the higher tonnage projects are mid-table or worse on grade. That may be okay depending on the processing required, as big miners can bring economies to scale to bear. However, higher tonnage is also likely to translate into higher capex, which, given that copper miners are still generally exhibiting capital discipline, may mean that M&A on these projects is likely to be some way off into the future, if at all. Remember I talked earlier of the many greenfield projects that have sat around undeveloped for a decade? Well, many of the projects bought by the majors in the last copper cycle a decade ago are still sitting and waiting to be developed, such as the Taca Taca project in Argentina or Haquira in Peru. Companies are reticent to repeat the follies of the past, and under the banner of capital discipline, they are sitting firmly on their hands at the moment. The hoped-for buyout, therefore, for juniors may be a long time coming. It is also generally much more difficult for a copper junior to make the leap and become a producer than for a gold junior company, for a number of reasons, including technical aspects, permitting a bigger project, financing a bigger project, and so on. So while gold juniors may be able to take to the step to go into production, if it cannot find a buyer, this is much less of an option for a copper junior. In general, copper projects tend to be bigger than gold projects, and so they tend to take longer to explore and advance to a construction decision. While a gold project may take 10 to 15 years, a copper project is likely to take more than 15 years. So therefore, funding a junior copper explorer is therefore more of a challenge. So look for companies that are well financed and have access to finance. We're going to have a look at the impacts or what the market thinks of copper juniors. There are various valuation metrics such as price to net asset value, or PNAV, enterprise value per measured and indicated resources, for example. Despite the pounds of copper, the key factor is often the perceptions of whether the market thinks a deposit can be developed. Here, I'm highlighting on the right-hand side Marimaca Copper and Filo Mining, which have similar valuations in terms of enterprise per pound of copper. However, Marimaca is small and high grade, Filo is lower grade but much larger. The key here is that both are likely to become mines. The market recognizes this and reflects this fact in their valuations. There can be many reasons why companies with large deposits and decent grade may have low valuations. Western Copper and Gold, circled here, for example, is a massive multi-metal resource in Yukon in Canada, but that brings a high capex as it needs to build infrastructure, which is beyond the financing capability of a junior company, typically. However, major miner Rio Tinto has invested in the company, and that could be a catalyst which could propel the stock much higher as its work progresses and Rio Tinto sees the potential there. So it is imperative to know the key milestones and timelines that copper explorers have about how quickly they can advance their projects, as those catalysts can be an entry point for investment or an exit point. This has been a relatively two-dimensional analysis so far, which does not take into account the other positive and negative factors that projects may have going for them. For example, Arizona, Sonora and Copper has a lot of existing infrastructure, so does Marimaca Copper. This is a picture of Marimaca Copper's site in northern Chile near the coast. As you can see, they have power, a highway, airport, port facilities, local workforce, all very close to the project. So that means they have lower capex in their project development budget, as they will not have to fund the development of such things. Companies that are in the boondocks in northern Canada or in some parts of the Andes may have to develop a lot of this themselves, which all adds to their capex. Another example is Los Andes Copper. It's adjacent to some of the very largest copper mines in Chile, so that could potentially be a bolt-on acquisition for a bigger miner. However, the most important factor perhaps to investigate prior to investing has to be the jurisdiction in terms of what is happening nationally and locally, which means it is essential to have a long, hard look at jurisdiction risk factors. Pictured here is Bristol Bay in Alaska, near where Northern Dynasty hopes to develop its massive Pebble project. Getting a lot of resistance there, and I think you can all see why. People don't want this landscape disturbed by an open pit copper mine. I generally think that a broad brush, though, to evaluating political risk is unhelpful, as the devil tends to be in the detail. However, I'll make a bit of an exception to that with Peru and Chile. This is a picture from Peru. This is local people protesting against the Las Bambas copper mine. The current government in Peru is making life difficult for mining investors, not so much through seeking to raise rents, although this is the case, but more through increasing instability in the country. With a weak government at the helm, communities feel more empowered to press their claims against the government and against mining projects and resisting new developments, such as here at, well, not new development, but such as here at Las Bambas. The investment case for Peru is currently difficult to build, because it's currently difficult to build and operate and to explore in the country. The situation regarding Chile may be similar, albeit for different reasons. With the new government at the helm and a constitutional reform process running, there is an element of legal instability in Chile at the macro level at the current time. However, the government has made it clear that it wants to increase rent from mining, while at the same time increasing environmental licensing and permitting aspects, particularly related to water. So permitting in Chile is going to become much more challenging. For example, Anglo American is being refused a permit to extend the life of its existing Los Bronces mine. However, the government has acknowledged it needs mining and wants more of it. Unlike in Peru, junior exploration for copper in Chile is starting to experience something of a boom. A number of new companies have been formed, which have acquired projects from major miners, and state copper company Codelco recently announced it is seeking exploration joint venture partners. This is unprecedented, and it stems from the fact that the government also wants to make changes to the concession system to reduce the ability of large landholders to sit on their claims without advancing exploration work. So large concession holders such as Codelco and others are now seeking partners to explore rather than lose the potential they have sat on for so many years. This is a map of Chile cut in half, showing some of the projects that Codelco is offering, seeking partners to help explore. In this instance, the long gestation period of a copper exploration project is a positive. It means that explorers are comfortable investing in Chile, as there will likely be a different government in office when they are likely to seek their permits. I predict that future VRIC events will have an increasing number of copper juniors from Chile participating. Now, to return to my view that political risk is best viewed from the regional rather than national level, Trilogy Metals is a great example of this. US President Joe Biden supports the development of critical minerals. I mentioned before that copper is not on his list, which may explain why copper projects in the US are having such a hard time with federal regulators. Last week, Hudbay Mining's Rosemont got another kick in the nuts from the feds. Trilogy has a great project, widely supported by many local government and Native American communities, but the feds are blocking the crucial road development the project needs. This is the Ambler Access Road. And this slide shows what can happen when political risk does indeed bite you on the arse. This is Northern Dynasty, if I'm not mistaken. Similar situations, this is Trilogy. Similar charts have been seen by Northern Dynasty with its Pebble project in Alaska. Antofagasta Minerals has also faced similar decisions from the federal authorities for its Twin Metals project in Arizona. All this means that copper projects, development projects, are increasingly scarce, which for those that are possible, the price rise potential is very, very good indeed. The importance of understanding the local level can be seen in Arizona. As I mentioned, this is Rosemont, which has recently, last week, got another negation from the government. But there are other projects. Resolution, for example, has also faced considerable community resistance due to the specific locations of those projects. However, Arizona, Sonoran, and others have not faced the same kind of resistance. So some parts of Arizona are not workable, other parts are. You have to be in a very specific location, and understanding the immediate vicinity is very, very important here. This principle is also very evident at what has become the most exciting copper exploration district in the past couple of years, San Juan in Argentina. Argentina is a republic where the provinces have control over their natural resources. And so one has to principally look at the provincial level rather than at the federal level to gauge risk. The boom in San Juan, there's at least 60 drill rigs operating at the moment. You can't get drills or drillers or technical services for love nor money. San Juan is pro-mining and has a lot of copper potential. Filo Mining, Jose Maria Resources, which is now Lundin Mining, Aldebaran Resources, McEwen Copper, to name a few, are all exploring there. A flood of drill results coming out, some very, very good stuff, very high grade or relatively high grade and long intercepts coming out. However, many people are wary of investing in Argentina due to the ever-changing fiscal regime and the possibility of new taxes coming out of the blue, such as the imposition of export taxes, foreign currency taxes, and so on. While these concerns remain, there may soon be greater clarity as Jose Maria Resources, which is now Lundin Mining, is in advanced discussions with the national and local government about taxation, fiscal stability agreements, and other aspects, which, if successful, may provide a blueprint for the development of other projects. The Lundin Group previously achieved this kind of turnaround in Ecuador with Lundin Gold and the Fruta del Norte project. The tax agreement they reached provided other investors with the confidence to enter the country and explore. But even so, the risk perception may remain until an asset is fully de-risked. On this chart, have a guess where Fruta del Norte achieved its first production and therefore became real and completely de-risked. Lundin Gold has now declared its first dividend. It's one of the best has one of the best dividend yields in the gold sector, and they've got a lot more exploration upside there to come. So, in closing, go copper, but look for grade and tons. Look what the catalysts are for the company over the next 6 to 12 months, and have a really good look at what the jurisdiction risk factors are at a local level. Thank you very much.